How many times have you looked for a retracement play that looks just like this, where you have a market structure shift, fair value gap, and now we're looking for the retest for the market to head lower, only to get stopped out just like this, which ends up leaving you like this and your computer screen just like that? Well, no worries, because today I'm going to show you guys exactly how to properly analyze the markets using a simple yet effective time frame alignment approach. And this is the same time frame alignments that has gotten me results just like this, with multiple payouts across multiple different firms. Now, if you guys are also new to the channel, I created a free Telegram where I post my trade ideas and additional trading resources and videos that I'll post, like trade breakdowns and additional educational content. So make sure to check that out. Link is in the description below. It's 100% free. Now, let's go ahead and let's begin. First, we have to understand time frame sequence. So many times, people will have a specific bias on a specific time frame, but then they're on a time frame way too low. For example, if we go back to that first slide, most people will look for like a 5-minute confirmation, but then they're trying to trade a daily bias. That is too far apart, which is why I've created the time frame sequence that I personally use in my trading. So for example, weekly bias, right? If I have a weekly bias, I'm going to be looking for a daily or a 4-hour confirmation. So many people, if they have a weekly bias, or maybe they're trying to go down to the 1 hour, maybe they're trying to go down to the 15-minute. It's very difficult to time that low of a time frame using a weekly bias, which is why I focus majority of the times on the daily and the 4-hour confirmation. Same thing with the daily bias. If I have a daily bias, I'm going to look for an H4 confirmation. And if I have a 4-hour bias, then I'll use a 1 hour or M15 confirmation. This is my time frame sequence. If I have a daily bias, I do not jump into the 1 hour or M15 confirmation. I need my daily bias to be present. I need to see my 4-hour confirmation. Now, if my 4-hour confirmation then can turn into a H1 M15 confirmation, as we're going to see later in the video, then we can go ahead and have that sequence. But if I have a daily bias, whether that's bullish or bearish, I need to see my 4-hour confirmation. Now, there are multiple ways to determine bias. I have a bunch of videos on my channel in regards to bias, but for the sake of this video, we're going to use a very simple tactic using market structure, and then I'm going to implement the confirmation entry type as well. And then we're going to put these two together in examples on TradingView. Now, as we all know, this is the very base level of understanding market structure. So in this example, let's just say the market has a swing low, swing high. Typically, the market is going to have some sort of retracement, especially if there's some sort of fair value gap or reference point that's in here. And then we could typically anticipate a higher low. And if a higher low does form, we're going to essentially make new highs. This gives us the framework to target this high right there. And if this is a daily chart, if this is a 4-hour chart, if this is a weekly time frame, this gives us a directional bias when we can correctly anticipate a trend. Same thing with a downtrend. The market will typically have some sort of high, we'll have a low, we'll have the market making a lower high, then making new lows. So in this sequence, again, we can then use these to target specific objectives, and then this gives us a directional bias, especially if this is on a daily time frame, weekly time frame. There's a lot of range that we can go ahead and catch. Now, inside of these areas and the higher lows, we're going to be looking for a very specific confirmation type. We're going to pair that directional bias with one of my favorite confirmations, which is the EBP, engulfing bar play. If you're someone who's been around the channel, you already are familiar with that. Now, I have a whole playlist on the engulfing bar play on my channel. It's 3 videos, but it's very, very informative on how you can use this actually for a confirmation method, but also as directional bias methodology as well. But for the argument's sake, we're going to talk about what the engulfing bar is. So we're going to talk about the bullish engulfing. So essentially, this is when the market sweeps the prior bar's low, and then we have a close above the prior candle's opening price. Those are the only 2 requirements that I need for a bullish engulfing. Now, inversely, a bearish engulfing is when the market takes out the prior bar's high, and we have a close below the opening price. Again, some people require it to close below the full bar, and for the bullish side to close above the bar, I don't. It just needs to close below, in this example on the bearish side, the prior candle's opening price. Now, I'm going to go ahead into TradingView and we're going to pair these two together. And we're going to see how we're going to use the higher time frame bias with using a very simple market structure. And then how we can use the confirmation entry with the EBP together to create a full trading system that you can use starting today. So I'm going to show you guys a breakdown on the S&P 500, and we're going to start off with the weekly time frame. Now, for the sake of this example, we're going to be using this top-down analysis sequence that we just talked about. So we're going to have the weekly bias, and then we're going to look for the daily and 4-hour confirmation. Now, for entries, typically, if you're using a weekly bias or using a daily bias, as we talked about, we can just stick on the 4-hour. Now, there is a way to go from 4-hour to even lower, but for the sake of this video, I want people to just stick to the basics, because if you can stick to the 4-hour and develop that skill, you can then later on use the 4-hour confirmation to go down to the 1-hour, to go down to the M15, but I will use that in a different example. Let's break down this S&P. So we have this current impulse where the market has a swing low, we have an impulse push up, and we form a swing high, as we're going to see in here. Now, on this current impulse leg, we do see that we had a bearish fair value gap that was inverted, and now we have essentially a balanced price range of price at this level. Now we understand on this impulse leg, with this change in state of price, because this bearish fair value gap was inverted, we know that this is going to be a very logical level where if the market were to trade down into it, that we can look for a potential bounce. Now we're going to play this forward, and we're going to see how ultimately the market hits this area on the weekly time frame. Now, once the market hits this level, we know that in terms of this impulse leg from swing low to swing high, if the market has a bullish push up, we can look to target this high because it's going to be our higher high point. Think of like the basic structures. We have a swing low, the market forms some sort of swing high in here, and then what we're essentially looking for is a potential higher low, and then the market makes new highs, right? The basics of a bullish trend. So understanding the very basics of market structure, we can then look for the market to head up higher. Not only that, but we also have this area in here that we can look to potentially target these prior lows, just in the event that the market has an impulse push up, and then maybe we start to consolidate, or maybe we just start to fade off in general. So let's go ahead and actually let's break this down further. Now here we have the market hitting this level, and just a side note, typically, when the market hits a higher time frame key level, just like in the example we talked about in the beginning of the presentation, what most people see is this current structure. When they look for a potential retracement, now this becomes less probable, and it becomes less probability that the market will have some sort of continuation lower without some sort of headache. Because the reality is this: once the market hits a key higher time frame level like we did here, this pullback now becomes pretty dangerous. The market forms some sort of swing low, and we can start to see that the market consolidates, or we start to rip higher. Now again, knowing that the higher time frame bias based off the weekly time frame is bullish, we are going to start to look for signatures in price on the 4-hour time frame or the daily time frame for some sort of confirmation. So we're going to play this forward, and we're going to go ahead and see how the market operates. So currently the market is still bearish as we drop lower. So we have swing high, swing low. We're going to play this forward again, and then we go into a new day. And right here, we're going to see the market form what? Our H4 confirmation that we talked about, the EBP. Now I'm going to go ahead and I'm actually just going to highlight this. So it's going to be on the 4-hour time frame. And this is just my indicator that I have in order to identify the EBPs. So now on the 4-hour time frame, we're going to see, boom, right there, the market forms. And now most people are going to ask, so in this event, when the market forms the engulfing bar, because again, we swept this liquidity pool, we had a push up and we had a closure above the prior candle's opening price. Not only that, but we also swept this swing low in here. And we retested that higher time frame level. This is why I need to use the confirmation within a weekly bias or a very key higher time frame level. Now, when the market hits that higher time frame level and we also sweep liquidity, this gives us confidence to look for an objective to the upside in this example. Now, we obviously have the higher high that we look to target in here, but even if, let's just say we want to target maybe this order block, these relative equal highs as well, as we see that the market already hit that level, we're going to use these as potential trading ranges. So I'm going to mark from swing low to swing high. on the way to the potential higher high. And this could be another potential objective. We also have a bunch of imbalances. So as the market looks like this, let me just play this forward. As we start to form this bullish engulfing, we swept liquidity, key level. Now, again, what do we see? We see there's a bunch of equal highs in here. We have a potential upside objective, and we do have that higher high. Now, this is the main key thing when it comes to an entry. In this example, when you have a very wide range bar like this, where obviously this is a lot of points and your stop loss would have to be fairly wide, what I like to typically do is I like to put my stop loss beneath the bodies of the candles, especially when we have a very big wick like this. Also, this now becomes an order block as we have a closure above. And this essentially is something that I don't want the market to trade a little bit lower, because typically after a run on stops, we should see aggressive price delivery. So when we go ahead and use this information, this is how we can go ahead and place a stop. Now the entry, if you want to look for an entry around the 25% or the 50% of this overall candles range, that's one thing that we can do. However, if we just take entry on the close and then the open of the next 4-hour bar, we could put our stop loss down here. We can look to target that level. And then if we, let's just say we want to target a solid 2R in here. So then stop loss is there. This would be our 2R objective. Now we allow this to play out. We see the market head higher and to the TP. And ultimately, again, if you're someone who's a little bit more patient and you were looking to target a higher high, this would have gave you about 3R. So as we play this forward, we're going to see that the market actually gapped up and ultimately hit our objective, and this went past 3R. Now, this is why it's very important that we have a 4-hour confirmation, whether we have a daily bias, whether we have a 4-hour bias as well. Now, let's go ahead and let's take a look at another example. Now, here's an example of the EURUSD on the daily time frame. So as we see here, the market has an overall swing high down to swing low. We swept liquidity before the impulse moved lower. We also have this imbalance that is present. And now we know that if the market is going to form a lower high in here using basic structure, inverse of what we just talked about on ES, then we know that the market is going to head down to this low in here because it will then form a lower low. Now just think of it from the bearish perspective. We have the market essentially having a swing high down to a low. Then the market is going to make some sort of lower high in here. This high is going to be lower to the one to the left of it, and it's usually going to seek price down to make new lows, making a lower low. So again, using this as our bias on the daily time frame, we also have our key higher time frame level that's mapped out. So now let's go down to the 4-hour time frame and let's see if we can see a confirmation entry at this very specific level. So now that we have our range marked out, we're going to play this forward and we're going to see, do we see any potential bearish confirmation? Now again, guys, for the example of this video, I'm going to use my bearish confirmation as our engulfing bar. So we're going to see if we see something like that once the market forms. Now, we do form this bullish one. However, this sets price higher. Notice how we clear the liquidity, and what do we see on this next candle? We see the bearish engulfing form. So now this gives us our confirmation. Now, the reason why I included this is because this can be considered as our 4-hour bias now. And we can actually go down to the one time frame lower because now we have the daily in a bearish mode. We have the 4-hour bias now being bearish. So now we can actually go down to the 1-hour time frame and look to see, is there any sort of imbalance that's present inside of this area that we can look to trade short? So let's go ahead and let's break down the 1 hour. Now, as we can see here, we have this clear fair value gap that's outlined. So we can just look for the market to head back up into here. Now, how big of a retracement do you really want and expect? It's really up to you guys. Typically, if you want to just trade as soon as the market hits this area, the low of the fair value gap, that's also very possible. If you want somewhat of a deeper retracement, so let's just assume you want the 50% mark of the overall fair value gap, that can also be something that you look for. So let's go ahead and actually make the settings on this. So we add the midline. So now that could be a potential entry point. So let's actually go ahead and play this out. And remember, our target is just these lows in here. Now you guys see how we're able to put everything together from daily bias down to 4-hour, and then from the 4-hour bias, even refining our levels further onto the 1 hour. Let's go ahead and we're going to play this forward. We see, do we get that retest? The market comes into that area. Boom, we get into that 50%. So let's go ahead and put a short position on. So into that 50% mark. Our stop loss can go, there's two ways to do this. You can put it above the fair value gap by a few pips, or you can put it above the swing high. I like to put usually just above the fair value gap, just by a little bit, and then put my target again as our objective. Now again, guys, look how we were able to use the daily bias, the 4 hour, and the 1 hour. And all this together, we could still get a 3.4 RR on this trade. So as we play this further, we're going to see how this ultimately plays out. We start to see expansion to the downside. We actually see a market structure break because the market had to push up, break lower. We broke that swing low. So now we're going to monitor the trade. The market kind of fizzles out around the TP area, and then boom, down to the objective. Again, this is the power of using your time frame alignments within this context. So many people want to look for market structure breaks, but they lack this type of alignment and context. The truth of the matter is this: if you're able to catch one or two of these types of plays every week, you can honestly trade less and make way more money because you can actually put on a little bit more risk because now you have all these different time frames aligning. Now, if you guys enjoyed this video, would appreciate you leaving a like and sharing this video to someone who struggles with these different time frame alignments. And again, guys, if you want additional videos and additional resources, make sure to join my public Telegram. My public Telegram is where I post my trade ideas, where I post additional videos. If I do any types of trade breakdowns, I usually put them in there. So make sure to check that out, and I'll see you guys in the next video.